Hi there, welcome to a quick podcast. What I'm just going to look at today very briefly is what's now called a statement of financial position. It used to be called a balance sheet, and we'll have a look at a few changes that have happened. It's been changed in name because of something called International Accounting Standards, and that's just a standard way of doing final accounts, and it's used across the world. And there are one or two very minor changes. For those of you who've already done some balance sheets, the changes are very minor. Probably makes it more simple to do, although it does lose some of the information that the shareholders in particular might be interested in from the balance sheet. Okay, big changes then. Obviously the name, statement of financial position, it's still at a certain date because what it is a list of all the assets, liabilities and capital at a particular date. So unlike the income statements or the profit and loss account, which is covering a whole period of time, a year, financial year, this one just looks at the financial position of the company at the end of the financial year. And remember, that end of the financial year doesn't have to be the end of the calendar year. So it doesn't have to be the 31st of December. It could be the 31st of March, for example. Okay, the top half of the statement of financial position just covers the assets. And what we do, we put the long-lasting assets or the non-current assets, the ones that are going to last for more than 12 months at the top. In this case, we've just got two, motor vehicles and fixtures and fittings. For those of you who are a bit more advanced, I haven't included cost and depreciation in here because it's meant to be something that anybody new to accounts can use as well. Current assets, inventory, trade receivables, bank and cash. They're normally put in order. We call it order of liquidity, but what it actually means is the order in which they are going to eventually get turned into cash. So inventory comes at the top because what happens for most businesses is they need to sell the inventory. It then becomes a trade receivable, and the trade receivable eventually pays us the cash at the end of the month or at the end of a period. Okay, and then we've got the total assets. And what I've done here, I've deliberately put in these main figures here in bold. They're the figures that get added together to give us the total assets. You don't have to inset the current assets. I do that because otherwise you can get confused. You just have a lot of numbers all in a line and a column. If you inset the current assets, you can clearly see which figures you're going to add together because they're under one another. Okay, the second section of the statement of financial position is for your capital and liabilities. And the first thing to notice here is that the total liabilities and the total assets should always be the same figure. So like a balance sheet, statement of financial position does balance. Okay, here we have got though the big difference between the balance sheet and the statement of financial position. We start off with capital. That's the longest lasting investment in a business because it's going to be there until the business closes down. And we start with the opening balance for the, in this case it's the sole trader's capital. We add on the profit for the year, and that gives us the subtotal here, which in this case is 57,000. And then we subtract from that the drawings. And if you remember from the podcast on where we've talked about the different elements of accounts, drawings are what the owner's taken out of the business, and you come up with a figure which is the capital or the investment of the owner in the business at the end of the year. We then do the non-current liabilities, so that's the second longest lasting investment in the business, and they're loans that are going to be paid in more than 1 year. In this case, we've got two worth 50,000. One's a mortgage, remember that's normally associated with buying a property. And then finally, we have the current liabilities. In this case, we've just got trade payables. And again, I've put all these figures here in bold now. These are the three figures that add together to give you your total liabilities. And what we should do at the end is have a quick check. Right, what I've got you to do, and there's a little bit more to the podcast after you've done your work, because I'm going to show you some exam board material. But I've got two quick exercises. First exercise, you've got a statement of financial position, and you've got all the headings. And what you need to do is to fill them in, put them in the correct place, and hopefully yours will look like the answer. Okay, and then the second exercise, I've put the headings in and you've got to put the different elements in. and hopefully if I've set up the spreadsheet correctly, it will then do all the maths for you. So hopefully they're going to be useful. If you pause your monitor now and probably go through and do the 2 exercises, check your answers off, and then come back and we'll have just a quick look at the exam board material. Okay, exam board material, what I'm going to do is just very quickly compare for you statement of financial position and the standard balance sheet. And the reason why I'm going to do that is when you're doing past paper questions, you'll find that most of them have got a balance sheet on it. So you'll need to be able to think, right, what are the differences? Am I doing this right? Obviously, one of the big clues that you're getting it right is if the figures balance. So your total liabilities equal your total assets. Okay, so non-current assets at the top, current assets, add them together. This one here has got the depreciation in. Don't worry about it if you haven't done depreciation yet. Just put in the total values. And then we've got the capital and liability section, capital, non-current liabilities, current liabilities, and total liabilities. And that compares with the old-fashioned balance sheet. You can see it starts roughly the same. You've got your non-current assets, you've got your current assets, but then we've got the difference. The liabilities are on the top half of the balance sheet, and then the capital figures are down here on the bottom section. So effectively, the top half of an old-fashioned balance sheet would give you your total assets, take away your total liabilities. This calculation here, that's exactly the same as we do on a statement of financial position with the capital for a sole trader. So that bit hasn't changed. It's these figures here, your non-current liabilities, your current liabilities, they fall in below the capital section and get added together. Okay, for those of you who are teaching, no problem. If you've got any problems with this, if you don't understand anything from this, obviously you can contact me. And for everybody else, hopefully that makes things a little bit clearer. So remember, the one that you're actually interested in, the one that you need to do, and I think all exam boards now have moved over to International Accounting Standards, is the top one here. Thank you very much, and hope this has been of some use. Bye.